Bernie Madoff's Ponzi scheme, one of the largest in history, was a masterful deception that spanned decades. At the heart of it, Madoff, a respected financier and former chairman of the Nasdaq, convinced thousands of investors, ranging from individuals to large institutions, that he was running a highly successful investment strategy. He promised consistently high returns, and the lure of these guaranteed profits attracted billions of dollars into his firm, Madoff Investment Securities. However, Madoff wasn't actually investing the money. Instead, he was using funds from new investors to pay returns to older ones, creating the illusion of a profitable business. This elaborate scheme continued unchecked for years, thanks to Madoff's reputation and the sophisticated fake statements issued to clients. But when the 2008 financial crisis triggered a wave of withdrawal requests, the facade began to crumble. As investors rushed to pull their funds, Madoff's firm couldn't meet the demand, exposing the scheme. His sons, who had become suspicious, reported him to authorities, and Madoff was arrested. The impact was devastating. Thousands lost their life savings, and institutions, including charities, faced significant financial ruin. He was sentenced to 150 years in prison, dying in 2021, but the repercussions of his crime still echo in the financial world today. The Enron scandal was one of the most infamous corporate frauds in history, revealing a web of deceit that led to the collapse of one of the largest energy companies in the world. At the core of this scandal were the company's top executives, including CEO Kenneth Lay and CFO Andrew Fastow, who masterminded a complex scheme of accounting fraud to inflate Enron's profits and hide its massive debt. By using off-balance sheet entities, they created the illusion of a financially healthy company while secretly loading it with liabilities. This allowed Enron to report earnings that were far higher than its actual financial situation, deceiving investors, employees, and the public. Enron's fraudulent practices went unnoticed for years, largely due to the company's deceptive financial reporting and the complicity of auditors at Arthur Andersen, one of the largest accounting firms in the world. However, in 2001, the truth started to unravel when the company's stock began to plummet, and investigations revealed the depth of the fraud. As the scandal came to light, the company declared bankruptcy in December 2001, causing massive losses for shareholders and employees, many of whom had invested their retirement savings in Enron stock. The impact of the scandal was profound. Thousands of employees lost their jobs and retirement funds. Investors were left with worthless stock, and the public lost trust in corporate America. Enron's executives were prosecuted, and Arthur Andersen, once a prestigious firm, was destroyed. The scandal led to the Sarbanes-Oxley Act of 2002, which implemented stricter regulations on financial reporting and corporate governance to prevent similar frauds in the future. The 1MDB scandal, one of the largest financial frauds in modern history, centered around a Malaysian state investment fund, One Malaysia Development Berhad, 1MDB, which was established in 2009 with the goal of driving economic development in the country. However, key figures in the Malaysian government, including former Prime Minister Najib Razak, used the fund as a personal cash cow, misappropriating billions of dollars. The mastermind behind the fraud, along with several high-ranking officials, siphoned off money from 1MDB through elaborate schemes, including fake loans and misdirected investments, and funneled the funds into their personal accounts or used it for extravagant purchases like luxury real estate, artwork, and even funding Hollywood film. The scheme remained largely undetected for years due to the involvement of powerful figures, corrupt financial institutions, and a lack of transparency. However, the truth began to surface in 2015 when journalists, whistleblowers, and international financial regulators started to raise red flags about suspicious transactions linked to the fund. Investigations revealed the vast scale of the embezzlement, with approximately $4.5 billion of 1MDB's funds stolen. This led to criminal probes by authorities in multiple countries, including the United States, Switzerland, and Singapore. The impact of the scandal was far-reaching. It tarnished Malaysia's global reputation, crippled its financial sector, and sparked mass protests against the government. In Malaysia, former Prime Minister Najib Razak was arrested and charged with corruption, money laundering, and abuse of power, eventually being convicted in 2020. The scandal also led to significant reforms in Malaysia's financial oversight. The WorldCom scandal, one of the largest accounting frauds in U.S. corporate history, involved the telecom giant WorldCom, which at its peak was the second largest long-distance phone company in the world. The mastermind behind the fraud was WorldCom's CEO, Bernard Ebbers, who, along with his top executives, orchestrated an elaborate scheme to inflate the company's financial statements and hide its growing debt. The company used fraudulent accounting practices, such as capitalizing ordinary expenses as investments and overstating its earnings by $11 billion. This created the illusion of a profitable and thriving business, masking the financial struggles the company was actually facing. The fraud went unnoticed for several years, largely due to the complicity of WorldCom's auditors, Arthur Andersen, who failed to properly review the company's books. However, in 2002, the fraud was exposed when the company's internal auditors, led by Cynthia Cooper, discovered the discrepancies. After an investigation, it became clear that WorldCom had been falsifying its financial results for years, leading to the company's bankruptcy in July 2002, which wiped out investors and employees who had trusted the company. The scandal led to the conviction of Bernard Ebbers, who was sentenced to 25 years in prison for his role in the fraud. The collapse of FTX, once one of the largest cryptocurrency exchanges in the world, was a stunning financial scandal that sent shockwaves through the crypto industry. Founded by Sam Bankman-Fried in 2017, FTX quickly became a major player in the digital asset market, attracting millions of users with promises of high returns and user-friendly services. However, behind the scenes, Bankman-Fried and his team engaged in a web of fraud, mismanagement, and risky financial practices. The company misused customer funds by lending them to its sister hedge fund, Alameda Research, which made high-risk investments that ultimately backfired. In addition, FTX manipulated its own token, FTT, inflating its value to prop up both FTX's balance sheet and the failing operations of Alameda. The scandal began to unravel in November 2022, when a report from CoinDesk raised concerns about the financial health of Alameda Research, specifically its heavy reliance on FTT tokens as collateral. This prompted a wave of withdrawal requests from FTX customers, exposing the liquidity crisis. Within days, FTX filed for bankruptcy, and Bankman-Fried resigned as CEO. Investigations revealed that FTX had misappropriated billions of dollars in customer funds, leaving users, investors, and creditors with little recourse. The impact of the FTX collapse was far-reaching. It shook confidence in the cryptocurrency market, with billions in investments lost, and many major firms in the industry facing financial turmoil. Sam Bankman-Fried was arrested and charged with fraud, money laundering, and campaign finance violations. The scandal also highlighted the lack of regulation in the cryptocurrency space, prompting calls for stricter oversight to prevent similar failures in the future. The Stanford financial Ponzi scheme, orchestrated by Texas financier Alan Stanford, was a massive fraud that spanned over 2 decades, deceiving investors out of billions of dollars. Stanford presented himself as a wealthy, successful businessman, offering high-yield investments through his company, Stanford International Bank, located in Antigua. He promised returns of up to 15% annually, far higher than what traditional investments offered. However, the returns were too good to be true. Stanford was not investing the money. Instead, he was using funds from new investors to pay returns to earlier ones, a classic Ponzi scheme. The fraud remained undetected for years due to Stanford's polished reputation and the legitimacy of his operations in the Caribbean. However, in 2009, the U.S. Securities and Exchange Commission, SEC, uncovered the scam after a whistleblower revealed discrepancies in the bank's operations. Investigations showed that Stanford had misappropriated $7 billion, leaving thousands of investors with worthless assets. Stanford was arrested and convicted in 2012 on charges of fraud, money laundering, and obstruction of justice. He was sentenced to 110 years in prison. The impact of the scheme was devastating, wiping out the life savings of many investors and underscoring the need for stricter regulation and oversight in financial markets to prevent such massive frauds. The Wirecard scandal, one of Germany's largest financial frauds, centered around the company Wirecard AG, a fintech giant that provided digital payment services. Founded in 1999, Wirecard became a darling of the tech industry, boasting impressive growth and gaining a spot in Germany's prestigious DAX 30 stock index. However, the company was hiding a massive financial hole. Wirecard falsely reported having over €1.9 billion in cash, which it did not possess. CEO Markus Braun and other executives inflated the company's financials, deceiving investors, regulators, and auditors. The truth came to light in June 2020 when Wirecard's auditors, Ernst & Young, revealed they could not verify the company's financial statements. Investigations uncovered that the reported cash was a fabrication, leading to Wirecard's insolvency. CEO Braun fled, but was later arrested. The scandal rocked Germany's financial sector, highlighting regulatory failures and leading to calls for better oversight of fintech companies. The Petrobras corruption scandal, one of Brazil's largest political and corporate scandals, revolved around Petrobras, the state-controlled oil giant. The scandal, known as Operation Car Wash, began in 2014 when investigations revealed that Petrobras executives, in collusion with politicians and construction companies, had orchestrated a massive kickback scheme. Companies awarded lucrative contracts with Petrobras, inflated prices, and paid bribes to key officials in exchange for these contracts. The corrupt practices were deeply embedded, involving billions of dollars over the course of a decade. The scandal unraveled when former Petrobras executives and politicians were arrested, and evidence pointed to widespread corruption at the highest levels of government, implicating former Brazilian President Luiz Inácio Lula da Silva and others. The revelations led to a series of criminal trials, protests, and political instability in Brazil. The impact was severe, tarnishing Petrobras's reputation, causing a sharp decline in its stock price and damaging the country's economy. The Health South scandal, one of the largest accounting frauds in U.S. healthcare history, involved Health South Corporation, a leading provider of outpatient surgery and rehabilitation services. The company, led by CEO Richard Scrushy, falsely inflated its earnings by over $2.7 billion to meet Wall Street expectations and maintain its stock price. Health South executives used a variety of fraudulent accounting practices, including creating fictitious profits and manipulating financial statements to conceal the company's financial troubles and mislead investors, auditors, and regulators. The scheme was uncovered in 2003 when a whistleblower and internal investigations revealed the magnitude of the fraud. Scrushy, along with several senior executives, was charged with securities fraud, conspiracy, and other crimes. Scrushy was acquitted of some charges, but later convicted on others, receiving a sentence of 7 years in prison. The scandal had a significant impact on Health South, leading to massive financial losses, stock price collapse, and widespread layoffs. It also sparked increased scrutiny of corporate accounting practices and led to stronger regulatory oversight in the healthcare sector. The Toshiba accounting scandal, which came to light in 2015, involved Toshiba Corporation, a global electronics and engineering giant. The scandal revealed that Toshiba had overstated its profits by nearly $1.2 billion over a period of 7 years. The company's executives, including CEO Hisao Tanaka, pressured employees to artificially inflate earnings by overstating project profits and manipulating accounting methods to meet financial targets. These practices were meant to boost stock prices and satisfy investors' expectations. The fraud went undetected for years due to a culture of corporate pressure and a lack of proper oversight. However, in 2015, an internal investigation uncovered the extent of the financial misreporting. The revelation led to the resignation of top executives, including Tanaka, and a sharp decline in Toshiba's stock price. The impact was severe, damaging Toshiba's reputation and causing significant financial losses. The scandal also prompted calls for better corporate governance and transparency in Japan, ultimately leading to reforms in accounting and oversight practices. The OneCoin crypto scam, masterminded by Ruja Ignatova, was a massive Ponzi scheme disguised as a cryptocurrency investment opportunity. Launched in 2014, OneCoin promised investors high returns through its own digital currency, claiming it was a revolutionary alternative to Bitcoin. However, OneCoin was not a legitimate cryptocurrency. The company fabricated its trading volume, falsely inflated its value, and operated a network of affiliates who recruited others into the scheme, earning commissions on new investments. Ignatova and her partners used a complex web of false claims and deceptive marketing to lure in millions of people worldwide, collecting an estimated $4.4 billion from investors. The scam began to unravel when Ignatova disappeared in 2017, leaving behind a trail of victims and a crumbling organization. Investigations revealed that the so-called cryptocurrency had no real value, and the entire operation was a classic Ponzi scheme. Several OneCoin executives were arrested, and Ignatova remains on the run, one of the most wanted fugitives in the world. The impact of the OneCoin scam was devastating, as it caused massive financial losses for unsuspecting investors. The Charles Ponzi scheme, which took place in the early 1920s, is the fraudulent scheme after which all other Ponzi schemes are named. Charles Ponzi, an Italian immigrant to the United States, promised investors high returns on international postage stamp investments, claiming he could buy discounted postal reply coupons abroad and redeem them at a higher value in the US. He promised a return of 50% in 45 days or 100% in 90 days. However, Ponzi was not actually investing in postal coupons. Instead, he was using money from new investors to pay returns to earlier ones, creating the illusion of a profitable business. Ponzi's scheme grew rapidly, attracting thousands of investors who poured in money, believing they were part of a legitimate investment opportunity. The scheme collapsed in 1920 when it became unsustainable, and investigators revealed that Ponzi had never actually purchased any coupons and was simply paying returns with incoming funds. The scandal led to Ponzi's arrest and conviction for fraud. His fraudulent activities caused significant financial losses, estimated at around $20 million at the time. The case sparked widespread awareness of fraudulent investment schemes, leading to increased scrutiny and regulation of financial markets. Ponzi's name became synonymous with investment fraud and remains a warning about the dangers of high-risk, unregulated financial ventures. The Volkswagen Dieselgate scandal, which broke in 2015, involved the German automaker Volkswagen VW using illegal software to cheat on emissions tests for its diesel vehicles. VW marketed its diesel cars as environmentally friendly, boasting about their low emissions and fuel efficiency. However, the company secretly installed defeat devices in over 11 million vehicles worldwide, which manipulated emissions levels during testing. In reality, the vehicles emitted far higher levels of nitrogen oxides than allowed by environmental regulations. The scandal was uncovered by an investigation conducted by the U.S. Environmental Protection Agency, EPA, which revealed the discrepancy in emissions levels. VW initially denied the allegations, but further research proved the use of defeat devices was widespread. The revelation led to a massive recall of affected vehicles, a plummet in VW's stock price, and legal actions across multiple countries. The impact of the scandal was severe. VW faced billions of dollars in fines, settlements, and lawsuits. The scandal also damaged the company's reputation and trust with consumers, highlighting the importance of corporate ethics and environmental responsibility in the auto industry. The Dieselgate scandal also led to stricter global emissions testing standards and increased scrutiny of environmental claims made by automakers. Theranos scandal involved the once promising health tech company Theranos, founded by Elizabeth Holmes in 2003. Holmes claimed her company had developed a revolutionary blood testing technology that could perform a wide range of medical tests with just a few drops of blood at a fraction of the cost of traditional methods. The technology attracted significant investments, partnerships with major companies, and a valuation of nearly $9 billion at its peak. However, in reality, the technology did not work as promised. Investigations revealed that Theranos had manipulated test results, misled investors, and covered up the failures of its devices. Holmes and former Theranos COO Ramesh Sunny Balwani were accused of deceiving patients, doctors, and investors about the capabilities of their blood testing technology. The scandal came to light in 2015 when investigative journalist John Carreyrou of the Wall Street Journal exposed the truth behind Theranos technology. Holmes and Balwani were charged with criminal fraud, and in 2021, Holmes was convicted on charges related to misleading investors. The Adelphia scandal, which came to light in the early 2000s, centered around Adelphia Communications Corporation, once the fifth largest cable company in the United States. Founded by John Regas and his family, Adelphia became a major player in the cable industry, but behind its growth lay a massive financial fraud. The Regas family used the company's assets for personal gain, like borrowing billions of dollars and funneling the money into their own pockets. They also inflated the company's earnings by hiding debt and misrepresenting financial records, making Adelphia appear more profitable than it really was. The scheme unraveled in 2002 when the company was unable to explain discrepancies in its financial statements, and investigations revealed over $2.3 billion in off-balance sheet debt. The Regas family was charged with securities fraud, bank fraud, and other crimes. John Regas and his son, Timothy, were convicted, leading to prison sentences.